Well, thank you all for attending this talk. Yes, as Pike mentioned, this presentation is entitled Forestry Investment Portfolios Under Climate Change and Market Uncertainties in New Zealand. Okay, so just a quick summary about what we're going to talk about here is what are optimal portfolios? How do our forestry portfolios address climate change risk? I'll show you a little bit about the underlying portfolio data that we used. Then I'll show you the portfolio scenarios and results we got. And then we finalize with some conclusions and future research directions, okay? So when we think about investments, arguably we can say that they are associated with an expected return and an expected risk as well, right? And different investments have different expected returns, different risks. And pretty much every investor would agree that diversification reduces exposure to risk, and a common path towards diversification is to reduce risk by investing in a variety of assets or investment options, and that is pretty much the definition of a portfolio. Okay. All right, so how do we construct a portfolio? What you're seeing here is basically some screenshots that I took from my phone where we can check the prices, the historical prices of some stocks, basically. Okay, here you have 4 different stock options, and you can come up with a portfolio that, and just by looking at these graphs, you can extract some useful information about these potential assets, okay, that are going to be part of your portfolio. You can look at the risk associated with them, and risk is really, in terms of portfolio analysis, just the volatility of the time series, and it's often expressed as a standard deviation. Okay, and also looking by these graphs, you can also estimate what are the returns associated with these different stocks. Okay, so you could look at the stocks and come up with a portfolio where you have equal parts of your portfolio distributed across these 4 options, or you could emphasize a specific option here. Oh, my mouse is not really helping me right now, but anyways, it doesn't matter. Or you could have even a third type of portfolio where even though you have 4 options here to choose from, you actually decide to go with 3 of them. It doesn't really matter, right? So what is gonna really help you defining how your portfolio should look like is your objectives, right? Okay, but there's a difference between constructing a portfolio and constructing an optimal portfolio, okay? And to construct optimal portfolios, we need to have in mind a concept that's called efficient frontiers. So graphically, we can see that the deforestation frontiers, a deforestation frontier looks like this, okay? Any point along this line, any portfolio that you create that falls along this line is arguably an efficient portfolio. And here we have the definition of an efficient portfolio. It's a portfolio that maximizes the expected return for a given amount of risk, or that minimizes the risk for a given expected return. Okay, the efficient frontier really represents the optimal trade-offs between expected returns and risk. Okay, if you are at the very bottom of this efficient frontier, you're arguably constructing a portfolio called minimum variance portfolio. Okay, that's the portfolio with the lowest possible risk. But again, you could be anywhere along this frontier, and all of these 3 points would represent optimal portfolios. Okay, they just have different objectives, but they're equally optimal or efficient. Okay. Now, what I showed you were examples of standard assets to construct portfolios, right? So assets based, for example, in stock prices. But our forest portfolios, they're different from that. they're actually based on annualized forestry returns, okay? And these annualized forest returns are just the annualized net present value of forest plantations. So we're talking about dollars per hectare per year, okay? Another thing to keep in mind is that when you're constructing standard portfolios, you're actually using historical price data. But here, we want to create forestry portfolios that address climate change risk. So we're talking about the future, right? So the way we can do that is using simulations, right? Because there's no such historical trends or data that we could use to create these portfolios, if not through simulations. And to come up with the simulations, basically, I mean, and there are two main important things that we need to simulate to create this annualized forestry returns. One of them is to simulate future forest productivity under climate change scenarios, so talking about wood volumes per hectare and also future log prices, right? We need to know the value of these wood volumes. All right, so if you followed this, you understood already 80% of everything that we did as part of this research, okay? But just to make sure, let me go over the steps that we took here. So our first step was to simulate future climate scenarios for 2020 to 2090. And we did that using IPCC models. But actually, saying IPCC models is a bit misleading. We use the same global climate models that the IPCC does, right? The Intergovernmental Panel on Climate Change. And we simulated these future scenarios for the different RCPs. Now, Anita already covered some of the RCPs, so the only thing that we need to keep in mind here is that we have 4 RCPs in this study, and RCP 2.6 represents a slightly warmer planet, and RCP 8.5 represents a much warmer planet. Okay, so we have the climate scenarios for each RCPs. Okay, then we used the data from this climate scenarios to simulate future forest growth. Okay, and we did that for Pinus radiata plantations using a forest growth model that's called 3PG. Why? Because one of the input variables that 3PG uses is actually climate data. Okay. So we could simulate future forest growth. In a third step, we created forecasts for log prices, and we use that simply applying some ARMA-GARCH models, standard models for time series analysis based on historical log prices. And then finally, we combined the information that we have simulated to compute the annualized forestry returns, okay? And then we're focused on this period of 2050 to 2090. And ultimately, this is the data that we used for our portfolio analysis. Okay. So let me show you how our future climate scenarios look like. Well, to begin with, these are the scenarios for our study region, and our study region is located, where's my map? Just north of Christchurch in a place called Ashley Forest. Okay, so here we have the results for the different RCPs. And these are the climate variables that we simulated from the climate models that are used as input in 3PG. Okay, so basically they all make sense. So temperature are increasing as the planet gets warmer, number of frost days decrease as the planet gets warmer. One thing to keep in mind is that what we are looking here are trend lines. The underlying data is actually very noisy. And you also can see that we have 6 different lines for each panel here, and these lines, each of these lines come from a different global climate model. Okay, are the IPCC, the same models used by IPCC. All right. So let me just show you how those climate data, how that climate data fits into the 3PG model. Here we have an example of forest productivity simulated with 3PG. Okay, we actually have wood volumes in cubic meters per hectare. We have different lines here. This represents how a given patch of forest is growing under the different climate scenarios. Okay, and what we are really interested here is not how the forest is actually growing, but actually the volume at harvest, because at the end of the day, it's this volume that we're going to convert into logs, and we're going to have a value for them, right? So, and here in this example, we're simulating a forest plantation that assumes a 30-year rotation. Okay, so here this dashed line represents harvesting, basically. So clearly, to be able to harvest a forest in 2050, the forest has to be planted in 2020. Okay, and assuming 30-year rotations, a forest that we're going to harvest in 2051 needs to be planted in 2021. Okay, so on and so forth. So we simulated this growth for every year from 2020 to 2090, basically. Okay, and we also simulate two different Pinus radiata regimes. One that is called T7S300 and T9S600. And the T really stands for the year when thinning takes place, and S represents the stalking, the final stalking, okay, after thinning. All right, moving on. So if we plot the volume of harvest for each year from 2050 to 2090 for each model, this is how it looks like. Okay, so there's a lot of variability here, and this variability comes from the noisy climate data. So we instead of working with each climate output here or 3PG output here, what we do is actually to create an average and a confidence interval around that average, and we use these thick lines here to create productivity scenarios. Okay, so the upper bound of our confidence interval is the high productivity scenario. The median, the average is actually the average forest productivity scenario, and then we have the low productivity scenario. Okay, so keep that in mind, because we're gonna work with these different scenarios here. Okay, we can also convert. That's what we did actually. We converted those volumes at harvest to log rate volumes, because at the end of the day, these are the volumes that we can assign a value to. Okay, and we did that based on, and we considered 6 different log rates here. So P1, P2, S1, S2, so on and so forth. And by playing with the proportion of these log rates associated with the volumes at harvest, we actually could go from 2 initial regimes to 4 regimes. Okay, so for each of these 2 regimes, we have them pruned and unpruned, and this is how the log rate proportions apply to the volumes of these 4 regimes. Okay, so we're basically multiplying the log rate proportion per regime by the wood volumes at harvest. Okay, here we have our forecast for the log rates. Okay, their prices. Here before 2020, we have the historical prices, and then after that, we have the forecast from the ARMA-GARCH models. We used a bootstrap method to again create 3 level of prices for our analysis. Okay, so we have high timber price scenarios, low timber price scenarios, and average timber price scenarios. Okay, so once we have all that data put together, and I can see that I'm running behind here, so sorry, I'll have to speed things up a little bit. We can come up with the annualized forestry returns. Okay, we're basically multiplying and summing everything. And this is how they look like. Okay, so we have the annualized forest returns here for each RCP, for each of the regimes that we simulated. And for each panel here, we have a time series for the annualized forest returns that are based on these different scenarios. Okay, and we're going to create 1 portfolio per scenario and per RCP. All right, so let me just when you look at the data like this, it's a bit overwhelming. So let me just clarify. It might be easier for you guys to follow what we did next. Okay, so we pick a scenario, and then we pick an RCP, and then we have these 4 lines, okay, one for each regime. And then we create portfolios based on these 4 lines, all right? In a way, these 4 lines, they're not different from picking 4 different stocks from the stock market, okay? In the sense, we're just doing a standard application of the portfolio theory based on these forestry returns. Now, I'm just gonna skip this slide. I'm sorry, but it's just the formulation behind portfolio theory, which is the theory that we used here for the optimization. But any paper on portfolio theory uses basically this formulation, so it's really not that important. I'm just about to show you the results that we have. And again, we'll have scenarios. We'll have one portfolio for each combination of forest productivity and timber price for each RCP, okay? So we'll have 9 scenarios like this for each RCP. And here are our results. So the first type of portfolios that we simulated are the minimum variance portfolios. And this is how they look like for 28-year rotations. We have the forest productivity here going from low, medium to high, the different log prices here, low, medium to high again, and then the different RCPs. So we can see how the portfolios, the composition of the portfolios change across the scenarios that we're simulating. And in this particular type of portfolio, all portfolios are based on unpruned regimes. And if you recall, that's because this minimum variance portfolio is looking to minimize risk, minimize volatility of the time series. And if you actually go back and look at how the time series look like, you will see that the unpruned regimes actually have a much lower volatility, and that's what's driving these results here. But we can create other types of portfolio, and this is one example where we set a given target return for the portfolio. Okay, so now the portfolio is trying to minimize risk once it reaches a specific return level. And then when we set a target return, we can see that we start to see pruned regimes that are more profitable according to the data that we simulated here. They started to appear in the portfolio, but once you have enough pruned regimes to meet your target return, then you again go back to the unpruned regimes for risk mitigation. Okay, so just quickly some conclusions and future research directions. This is rather obvious, but our forest regime, we find that forest regime diversification can reduce future climate change risk. But really what we are doing here is showing you a framework, right? A forestry portfolio framework. The results themselves are not that important or relevant. They would be more relevant if we apply this framework based on input from forest managers, based on perhaps different regimes, that based on their data. Okay, then this framework could become a decision-making tool for the future. Okay, we could also examine different tree species as part of the portfolio. We need data for that, but that could be interesting. Not only focusing on Pinus radiata as we did here, we could consider other sources of risk, for example, from diseases and fires, provided that we can simulate those in the future, how they're going to look like under the different RCPs. And we could expand our analysis to a regional level or even a country level, again, if we have the data to do so. But yeah, with that, thank you so much. I'm sorry I went a bit over time, actually a lot over time, but yeah, that's all from me. Thank you.